Let's break down what a Fed rate cut actually means and why it matters to everyone, not just Wall Street insiders or economists. The Federal Reserve is the central bank of the US, the big boss of money. It's responsible for keeping the economy stable, making sure prices don't rise too fast or fall too quickly, and helping people find jobs. Its main tool, the federal funds rate. The interest banks charge each other for overnight loans. This rate might sound technical, but it's the foundation for almost every other interest rate in the country. When the Fed cuts this rate, borrowing gets cheaper for banks, and for you. Suddenly it costs less to take out a loan, whether you're buying a house, a car, or starting a business. That means lower rates on mortgages, car loans, and credit cards, encouraging people and businesses to spend and invest. More spending means more demand for goods and services, which can help businesses grow and hire more workers. The goal? To jumpstart the economy when it's slowing down. By making money cheaper to borrow, the Fed hopes to get the economic engine running faster. For most people, this isn't just a headline, it affects your wallet. Whether you're paying off debt or thinking about a big purchase, a rate cut can change your monthly budget. If you have a variable rate loan, your payments might drop, freeing up cash for other things. That can make a real difference for families and small businesses. But if you're a saver, your interest earnings will likely shrink. Savings accounts and CDs pay less, so your money doesn't grow as quickly in the bank. It's a trade-off. The Fed wants you to spend, not save, to boost economic activity. The idea is to get money moving through the economy, not sitting idle. When the Fed acts, it sends shockwaves through markets worldwide. Stock prices, bond yields, and even foreign currencies can react in minutes. Investors, CEOs, and everyday people all feel the impact. Whether you're planning for retirement or running a company, a rate cut can change your financial strategy. That's why a rate cut is always big news. It touches every corner of the economy, and ultimately it touches your life too. So, why did the Fed cut rates on September 17th, 2025? The timing wasn't random. The decision came after months of mixed economic signals and growing anxiety in the markets. Investors, businesses, and even everyday consumers were all watching closely, wondering if the economy was heading for a slowdown. Fed Chair Jerome Powell called it a risk management cut. That means the Fed wanted to get ahead of potential problems rather than wait for a crisis to hit. Translation: they see trouble ahead and want to act before things get worse. The markets had been jittery, and there was a sense that waiting too long could make any downturn harder to control. The cut was a cautious quarter point, enough to show concern, not panic. It was a signal to the world that the Fed is paying attention but not overreacting. Not everyone at the Fed agreed. Some wanted a bigger cut, showing real debate about the risks. This split highlights just how uncertain the outlook really is. The Fed is trying to keep the economy balanced, not too hot, not too cold. It's a delicate act, and every move is carefully weighed. They're responding to signs like slowing job growth and global uncertainty. Trade tensions, weak manufacturing numbers, and shaky overseas economies all played a role. Cutting rates is like buying insurance for the economy, making it easier for businesses and consumers to keep spending. Lower rates mean cheaper loans, which can help boost confidence and keep money flowing. Powell signaled this isn't the start of a long series of cuts, just a strategic move for now. The Fed wants to stay flexible, ready to adjust if the situation changes. For investors, it's reassurance. The Fed is watching and ready to act if needed. In uncertain times, that kind of message can be just as important as the rate cut itself. Wall Street's reaction? Volatile. Stocks dipped at first, classic sell the news behavior, since traders had already priced in the cut. But by the next morning, optimism returned. Futures climbed as investors digested Powell's message. The market now expects more cuts soon, betting the Fed will keep easing if the data weakens. This creates short-term volatility, great for traders, stressful for long-term investors. But fundamentally, lower rates make stocks more attractive than bonds and reduce borrowing costs for companies. The initial messiness aside, the Fed's move is a medium-term positive for the stock market. The key, don't get lost in the noise. The Fed's support is a tailwind for stocks. Investors are already looking ahead to what's next. The Fed's move rippled across Asia, but reactions were mixed. The MSCI Asia-Pacific Index dipped, reflecting caution about why the cut was needed. Export-heavy markets like South Korea, Taiwan and Japan rallied, hoping for stronger US demand. But Australia and New Zealand fell, dragged down by weak local economic data. The split shows how global and local factors collide. For Asian investors, a US rate cut is both a boost and a warning. It signals opportunity for exporters, but also highlights global fragility. Decisions in Washington instantly impact markets in Seoul, Tokyo and Sydney. The global economy is more connected than ever. When the Federal Reserve cuts interest rates, it usually spells a weaker US dollar. That's because lower rates mean investors earn less from holding dollar-denominated assets, so they start searching for better returns elsewhere in the world. As a result, the dollar often loses some of its shine, and global investors shift their focus to other currencies and markets that might offer higher yields or more stability. Recently, the dollar index fell to its lowest level since early 2022, while the euro and the British pound both surged in value, reflecting renewed confidence in those economies. But currency markets are fast-moving and unpredictable. As traders and investors processed the Fed's decision, the dollar staged a comeback, and the euro and pound gave back some of their gains. Meanwhile, the Chinese yuan strengthened a bit as China kept its own interest rates steady, signaling stability in its financial system. These currency shifts aren't just numbers on a screen, they have real-world consequences. A weaker dollar helps US exporters by making American goods cheaper overseas, and it can boost tourism as foreign visitors get more for their money. But it also means imports become more expensive for Americans, raising prices on everything from electronics to groceries. For Europe and China, a stronger currency is a double-edged sword. It makes it cheaper to buy goods from abroad, but it can hurt their own exporters by making their products pricier in global markets. For travelers, a weaker dollar means your vacation budget won't stretch as far, making trips abroad more expensive and sometimes forcing tough choices about where to go or what to do. For multinational companies, currency swings can dramatically change the math on global sales, profits, and even long-term business strategies. Even if you don't trade currencies, these moves can hit your wallet, affecting the price of imported goods, your travel plans, and the health of businesses in your community. In today's interconnected world, currency values are part of a global balancing act, one that touches everyone, everywhere, whether we realize it or not. Commodities react fast to Fed moves. Gold soared to a record high. Investors flock to it when rates fall and uncertainty rises. Lower rates make gold more attractive, and a weaker dollar boosts demand from overseas buyers. Gold's rally is both a bet on more easing and a hedge against trouble. Oil, meanwhile, slipped. Why? The rate cut signals slower global growth, which means less demand for energy. Gold and oil are telling different stories. Gold sees monetary stimulus, oil sees economic caution. For consumers, lower oil prices could mean cheaper gas. For the global economy, falling oil is a warning sign. Commodities are the market's mood ring. Watch them for clues. The message investors are nervous and hedging their bets. The Fed isn't alone. Central banks worldwide are easing. Canada cut rates just before the Fed, and others are under pressure to follow. If they don't, their currencies rise, hurting exports. The Bank of England is likely to consider a cut soon if weakness persists. The global focus has shifted from fighting inflation to supporting growth. Coordinated rate cuts are meant to boost confidence and prevent recession. For borrowers, this means cheaper loans everywhere, but it's also a sign that economic leaders are worried. The era of rate hikes is over. Rate cuts are the new normal. It's a time for caution and for spotting new opportunities.